you choose to come into the United States, depending upon the goal and the modeling that you're trying to accomplish that inbound to the United States. We're going to discuss federal and state taxes. We're also going to discuss, in essence, there are specific incentives that both federal has for exporters or people that have an office here that export into South America or anywhere in the world, including Canada. And then we're going to talk about specific planning options available for expansion. And Joe will get into what I consider an area that most people only find out when they get a notice from a state of either the importation of product or they're doing nexus. That means that you're doing business in that state and you have not been reporting. Next slide. So we're going to go over the different types of entities, and every entity has its advantages and disadvantages. We've listed out the advantages and disadvantages. In this, again, this is available for you after, so you could read it further. But when we look at a particular client that's coming into the United States, we try to marry the objective of the client, whether they're producing a product, whether they're manufacturing a product, whether it's capital intensive, whether it's a sales and services, or whether it's a logistics. So what we want to do is actually cohesively effectuate a plan that not only addresses the United States, but it addresses a global tax efficiency. So if there are taxes here, those taxes, we will try to have them be available in your country. We look at tax treaties and what type of treaties country you're coming from. So in the United States, there is the first one is, and everybody's pretty typical on what, when they come to our office, they say, oh, I like to set up a limited liability company. And a limited liability company is a standard company that is established in the state of Florida. We recommend that you have an operating agreement. Most people do not a lot of times spend the money and time to get an operating agreement, but avoids a lot of conflicts of issues of allocation of profits. In a limited liability environment, the person that is a member of that entity has limited liabilities to the extent of the company. Now, obviously, you got to run it like a company, not an alter ego of yourself. However, a limited liability company is a company that you could not only choose to be a form of, and we'll look at it further, as a partnership, you could have it as a corporation, or you could have it as a company that in essence is completely disregarded, or you could have it thirdly as an S corporation. However, S corporations have certain limitations as to whom the shareholders can be. So when we look at a limited liability company, most clients that say, I want to have a corporate structure, in this scenario, you would have then be a taxable of 21% plus the state of Florida, if you're doing business in the state of Florida, of 5.5. But then if you have any other state, then you have additional taxes that are associated with that. So normally, a limited liability company is your best way to come into the United States because it allows you to also have partners that are non-residents, corporations, trusts, and you could actually divide the profits, losses, as well as income, depending upon how you, in fact, want to distribute that income to the partners. The issue with a limited liability company, it has a limited life and also has the self-employment. So most people do not realize that if you provide income through a limited liability company and you choose to treat it as a corporation, then you're taxed at 21%. If you choose to treat it as a partnership, then you're subject to self-employment taxes. And we also always recommend to put yourself in a salary that is reasonable or commensurate to your personal expenses that you need to pay. One of the ways that we utilize a limited liability company, and I make reference to here on the use of an IC disc. So imagine that we have a limited liability company that imports from, let's say, Spain, a certain product into United States, and that product is a composition of more than 51% is brought together, meaning you could send wine. The wine is in a juice. You bring your bottle here, you bottle it here, you label it here, and you distribute it here. If you distribute it to another country, we, as an IC disc, we employ an entity called an IC disc. It's an incentive for exporters, and then we're able to reduce the normal rate of 37% down to 20% if it's a partnership. If it's a corporation, it's 21%, and we're able to then extract profits through an IC disc that then it's taxed to the individuals at 20%. But I don't want you to think that an IC disc is the solution to all. You have to look at what type of business. So for instance, if you have a capital intensive business, normally we utilize the IC disc to extract profits and reintroduce them back as capital contribution to keep the growth going. The second one is a corporation. A corporation, for instance, is a basic limited liability to the extent of your corporate assets. So let's say, for instance, in a corporation, there is a separate incentive, and you'll see it in point number 2, which is called a FDII. That is an interesting that was passed by the Trump legislation, where instead of paying a corporate tax of 21%, this year it drops down to 13.1%. So it is a great way to, if you're exporting product to another country, meaning you are bringing product in and exporting it to another country, or you could be exporting services. So for instance, we have companies that come from Spain or Europe. They have a service center here that takes care of their LATAM, and they bill their LATAM subsidiaries. The LATAM subsidiaries pay the US entity, and that brings it down from 21% to basically 13.1%. In addition to that, because the services are exported, you're not subject to Florida sales tax, corporate income tax. So that is a very interesting way to really, what I would consider, reduce the tax implication. Although the United States at 21%, globally, most companies in Europe are at 25%, but the rates here are fairly low. There is a component. So for instance, if you are a corporation and you invest in a company that does IP, intellectual property, or they do any type of anything that does not include banks, insurances, or investment advisory, most people don't realize, and this is in Florida, we're beginning to see it because we have a lot of private equities that are moving from California to Florida. So why do private equities are moving here? Well, obviously because of the state income tax, but most private equities that invest, for instance, in intellectual property, if they sell their stock in that company, they could exclude $10 million or up to 10 times their investment. It's a great tool to really utilize in the software and in the IP area, because in essence, it provides a tax-free environment. Most people that are predator to a prey that want to buy your software normally buy your IP, which we normally advise to maintain your IP in a separate company than your operational company. So you may be bought out your IP by a separate company, and that is applicable to the 1202 stock. That has its nuances and limitations. We'll be more than happy to assist in any type of, there are specific requirements. It has to be original issue stock. It cannot be additional shares that you're authorizing and issuing. So there are limitations, but it is a great tool to utilize, especially South Florida. We're getting a lot of private equities, and we're getting a lot of activity in that area, and we're seeing this more and more being applied in the area of those industries itself. Next slide. This is these last two. These are partnerships. Normally, for instance, if you come from Spain, this is your typical SRL. It's your partnership where the partnership does not pay taxes, but rather it flows down to the individual, and that individual is going to be taxed on his or her proportional share in the profits that the partnership has. It is a great tool for real estate because you could have basically one type of partner as a limited liability partner. You could have a general partner. A lot of people have heard of interest carrying. Interest carrying is utilized a lot by private equity because instead of being taxed at 37%, the profit sharing interest carrying cost, in essence, you're taxed at 20%. So it's a great tool for real estate. It's a great tool to, I would say, for a business that is not capital intensive, because mostly the capital intensive businesses are redeploying that profits to grow. A partnership, in essence, you'll be taxed on it, whether the profits are distributed or not. The partners have, depending upon if they're a general partner, they could be subject to a lawsuit, and most of the time banks will require personal guarantees in partnerships as they do in corporations. But the difference in a partnership is that if you have a personal guarantee with a bank and you have losses, we could utilize those losses, what we call as basis. And that basis enables you to think of your loan with a bank as if it was capital in your partnership. So if you have losses in the beginning years, those losses will flow down to you, and you're able then to carry those losses going forward. Different than most other countries throughout the world, that those losses are not in way that the United States have, that you could carry those losses going forward. An S corporation is, and I put it here, but an S corporation is somewhat of the thing of the past. Why? Because an S corporation, although it's good for small businesses, that you're in essence creating a much smaller company, but it has limitations as to the type of shareholders. I'll give you an example. In an S corporation, you really cannot have a corporation that's a foreign entity, nor a US corporation be a shareholder. It will terminate the S election. However, the benefit of the S corporation as opposed to a partnership is a corporation has limited liability, and however, you got to run the corporation as the integrity of it. A lot of people, for instance, abuse an S corporation because they do not apply a salary. This is a major mandate by the IRS to look at unreasonable compensation. And so what we normally do is look at what you in fact are going to need, and then we have you on a salary. So in essence, you're justifying to the IRS that you can in fact clear your personal expenses with that salary. But we normally see a lot of IRS audits on people that do not appoint themselves a salary. They're taking things out all as distributions, different than a partnership. In an S corporation's distributions are not subject to self-employment taxes. The Biden administration tried to pass a law in the last, what they call the Green Book, to try to tax S corporation profits. So a lot of people abuse that and they don't put themselves on a salary. So in order to avoid an audit, you normally would put yourself on a salary. We recommend a 50-50 split. If you have profits of $100,000, you should be at a $50,000 salary, as well as in distributions, then you could take out. It's less of a likelihood of an audit. We try to be preventive. If we do our job right, we could avoid audits, as opposed to audits. Attorneys and accountants are the ones that benefit because it's a no-win situations a lot of times, because we're fighting, in some cases, an uphill battle, but in most cases we do win because they're applying laws that are not applicable to certain types of entities. So, but in an S corporation, you really have to look at that. You could have a non-voting, but you cannot have preferred stock. So normally people think you cannot have two types of stock in an S corp. You could have a non-voting stock as well as voting. So you could have a non-voting, for instance, if you want to have your employees participate in some form of a profit pool. And that way you can incentivize your employees to participate in the profit pool, but at the same time, not cut you out of the ability to make major decisions for the company on a voting side. Next one. So here, a lot of individuals come to us, and because again, it's the confusion of certain countries they seem to operate, and so they have a misunderstanding. So I always try to give them an example. Is we have a federal income tax that is a percentage of your business profits. As I said before, it's taxed at 21%. Florida, if you're doing business in Florida, it's taxed at 5.5%. That is if you treat your company as a corporation. However, if you treat your company as a partnership, you're not subject to Florida's taxes. However, Florida has sales taxes, and Joe will get into that, as well as property taxes. A lot of people are constantly saying, because Florida's properties have gone up almost 30 or 40%, depending upon the county that you live in. They're really homing in, because Florida feeds primarily their budget in a lot of these. And Joe will get into it. I don't want to step on his presentation, but you'll see where Florida collects the primarily. But for instance, most people don't realize that property taxes, you could challenge them. You could go and challenge what the value is. Some components can, some components don't. We've had a considerable amount of results on challenging real estate taxes on condos, for instance, if you don't have it rented and so on. So I don't want to touch too base, but just think about this. If you have a federal, state, and local, most people, when they come into our office, they only concentrate on federal. They really don't look at states, and they don't look at sales. Especially, we have a lot of e-commerce coming from Europe. E-commerce, you could be subject to sales tax in a variety of states. As a matter of fact, there's a list of every single state. You can either sell on transactions or sales volume. So, and you could be subject to nexus. Nexus is when you touch a state so much, or you have inventory, or you have sales, or you have rental property. You may have one of those depending upon the state, or you may have all three of them depending upon the state. The state may have a single factor on there. So most states are having tremendous amount of deficits. And so like California, New York, they're gonna want a piece of your business. So it's imperative that you plan not only federal, but you plan out your state and local, because that is really, a lot of times most people get significant audits. Joe just worked on an audit of a client. They got assessed for $5 million, and he was able to bring it down, I believe was it was 150,000, Joe.
Final
So
tax.
it was the lack of proper documentation. So we had to go through $5 million worth of documents, piecemeal it, but it did save the client a considerable amount of money. And so I think a lot of people don't realize that. Next slide. So I'm gonna, so a lot of people, and Joe, if you want to do the customs and excise tax and instant, and I'll chime in on the tax incentive and deductions for the FIDI and the IC disc if you want to touch base, because those are the areas that that's your expertise on that.
Sure. To make a point, the minute goods arrives from a foreign port into the United States, whether you intend to resell it in the United States or whether you intend to use it in your own personal residence as your own property, there is absolutely an import duty or customs fees on everything from furniture to food to machinery. So you have to be aware before you just give it to an ocean freight company, oh, bring my goods to Florida, bring it to the United States. The first stop in the United States is U.S. Customs Service, and they examine all the cargo, and they're pretty efficient. They determine what the value of it is, whether it's inventory for a business or furniture for your house, and they're going to collect the import duties or tariffs right at that point. So be aware before you begin to ship things. Your freight forwarder can assist you, but the United States will collect a tax. We're going to get into it in a minute, but the state of Florida gets an electronic feed of all the merchandise you import into Florida, whether it's personal furniture, jewelry, clothing, cars, boats, aircraft, or whether it's inventory for your business. And they too are going to attempt to collect a use tax. So very important to plan in advance before you bring goods into the United States or Florida. Number two, excise duties and tax. The federal government has unique taxes on alcohol, tobacco, motor fuels, as does Florida. So again, if your business model is to bring goods in from another country, get with the professional and know it in advance. Quite frequently, we have clients and businesses receive a notice from the state of Florida that says, greetings, we've obtained third-party information that you've caused the importation of 144 kilos of gold bullion into the state of Florida. The U.S. Customs Service informs us that was worth $106 million. We've taken the opportunity to compute the use tax. Please send it in the enclosed envelope. So you want to, the point is you want to plan before you just bring goods into Florida.
Yeah, to add, a lot of people, specifically wineries from Spain or from Italy, they ship product here and they say it's a sample. It's a sample for them to determine whether it's going to be marketable or not. Be careful, because there's only so many times you could say it's a sample, and also you have to determine the quantity. So we see that a lot in the wine business of a lot of, specifically from Spain or from Italy. For the most part, pretty much France consumes about 80%, and in country we don't see that much from France, but we do see a lot in Spain and in Italy. And we've had cases where it says no, this is not samples. We have a history of the last 3 shipments that you sent. This can no longer be sample. And so you get into a situation that, had it been done right, you don't have to pay us to get out of those things. So this is about planning, modeling, and structuring. The second one is interstate reporting. This is, we're beginning to see a lot of exchange of information between countries, particular Spain, particular Argentina, Mexico, and depending upon the political environment, whether it be Brazil, we're not seeing that much, but we are seeing the exchange of information either through a treaty partner, through an MLAT, which is a mutual lateral treaty agreement, or through a direct trade agreement. So the United States is sharing information of what's being brought in. Also, these countries are also saying we've shipped items, we've sold services, we have this type of activity. And so maybe a couple of years ago, people started getting what they call a BE12 or a BE14. And so that was trying to determine what type of business volume you were doing. And you had to do a considerable amount of information. A lot of people did not do it. They just threw it. And so a lot of times those are flagged depending upon the business volume. Obviously, there are thresholds. The United States, like every other country, cherry picks exactly what they're going to go after. They're not going to deploy, 10, 20, 30, 40, $50,000 in labor to go after a $1,000, $2,000. But you got then the state of Florida. State of Florida does the audit. The IRS piggybacks off audits for the state a lot of times, and they get that data. So today, for the first time, we're beginning to see artificial intelligence being employed by the IRS, and we're beginning to see a considerable amount of exchange of information, plus a much more efficient way to detect, anomalies, because there's no transfer pricing, there's no cost sharing arrangements. So for us, what we try to do is try to break down what are the federal taxes for individuals, what are the federal taxes for companies, what is the landscape that you're going to do being business on, and what do we need to, in essence, legally and justifiably reduce U.S. income taxes. For example, a transfer pricing, you may have a company that's here that their entire back end is in Spain. So that is what we call a cost sharing arrangement. Cost sharing arrangement is a legitimate. Every one of these two countries are part of the OECD. So we're very cognizant. The IRS has now embarked in a campaign for transfer pricing because they're realizing that there's a lack of discipline by businesses at a certain threshold. We're not talking about multinationals. Multinationals have this down to a science. We're talking about what we call the middle market, anywhere 100 million and below, maybe up to 20, 30. When you start getting, and depending upon the type of product, if it's a high product, for instance, we may have a Brazilian that sets up a distribution company for Caterpillar here, and they're just distributing here. So it may be very 5, 6, 10, but high ticket items. So they're looking at all of these. I cannot tell you that in the past we used to say, oh, don't worry if it's less than 2.5 million. Look, it all depends the type of business that you're in. If you're doing 2.5 million and having a 50% profit and you're squeezing it through some form of unjustifiable expense between a related party or unrelated through ownership, then they're going to look at that for sure. The last one that I will touch on is the tax incentive and FDII. I believe that a lot of companies are leaving money on the table because they are, in essence, not taking advantage of these 3 points. Why? Because you're reducing from 21 to 13 if you're doing a FDII, if you're a corporation, or you're not utilizing an IC disc. An IC disc is an incentive for US made products that the composition of that product is assembled or bought in the United States more than 50% value of that product. And lastly, as I said before, new technologies, research and development is a credit that you could use dollar for dollar against your income taxes. And if you don't utilize it, you could carry it forward. So those are very detailed analysis that we could assist. We normally do what we call as an impact study to see how it could be, these tools can be used, and we could be an assistance to you. I turn it over to Joe. Joe is now going to get into what I consider the unknown to a lot of people.
Thank you, Ray. My presentation today, what I want to discuss primarily is doing business in Florida. We're going to review Florida's taxes and where they impose and how they impose taxes. And we'll talk about both the burdens, the obligations, and also we're going to review some of Florida's incentives and tax benefits. Juan? Okay, Florida has approximately 6 major taxes. We have a lot of minor taxes. Our largest one is our sales and use tax, and that's imposed on tangible personal property, pretty much goods, and we'll drill down into that in a minute. Florida's tax rate is 6%, plus each of our counties, we have 67 counties, will generally add on their 1%. We have a communication services tax. This is the least known and most burdensome. It can be as high as 16% in different counties in Florida. Data circuits, mobile phone communications, land phone communication, business telephones, video streaming such as Netflix, Amazon Prime, television such as DirecTV or Xfinity. Those are all communication services subject to Florida's tax. We don't think much about them because the mobile phone bill comes in from Verizon. It's got a 16% tax on it, and we just pay it. Florida's communication services tax is very unique. It is not cited to where you're standing when you made a phone call. It's cited to where the bill is mailed. So certain businesses that have a lot of mobile phone accounts might have the mailing address on their mobile phone bills changed to Nevada. Nevada's communication services tax is 3 or 4%. Florida is 16%. Florida only cites based on the mailing address of the bill. Our motor fuel tax, certainly, we know what that is. It's on motor fuels, both highway fuels and specialty fuels. Documentary stamp tax we'll talk about a little deeper, but that's a tax on the transfer of real estate by documents. The seller will pay a tax on the transfer. It's a tax on lending instruments. The borrower will pay a documentary stamp tax, whether they borrow money for business reasons or whether they borrow money on real estate. Florida's corporate income tax rate is 5.5%, and it has some nuances to it, but generally we take our entire United States profits, which is reported on a federal tax return, and we calculate how much of the profits were earned in Florida through a process called apportionment. And if your US profits were $1 million and apportionment says that 10% of your profits were earned in Florida, then your $100,000 in Florida tax, Florida profits are exposed to a 5.5% tax. And then we have Florida's insurance premium tax. We don't think much about it, but it's on every insurance bill.
Joe, that's a very good question on that, because a lot of exporters that do business in the United States, that they export the product to another country, we get a lot of tax returns that they don't exclude what's been exported. So people are paying corporate taxes on the total amount. So very ridiculous.
No, you bring up a good point, Ray. In general, we determine where the sales and the profits are based on where we ship the merchandise to. If we're manufacturing widgets here in the United States and half of them are shipped outside of Florida, then they're not exposed to Florida's tax. But knowing where your product goes is very important to minimize your state taxes.
Yep.
Okay, I said a minute ago, the big guy in the room, as you can see, is Florida's sales and use tax. This is the prior year revenue source for Florida's prior fiscal year. So I don't have to tell you the Florida tax authorities take sales and use tax very, very seriously. Severance taxes, they're not so serious about, but this state is run last year, $46 billion in tax revenues came in from sales and use tax. Just by way of introduction, Florida's annual budget is about $110 billion. $59 billion comes through general taxes. About $30 billion are grants from the federal government, and the rest are what we call trust fund taxes, which are taken in and must be used for specific purposes. So what I want you to know is if you're thinking of doing business in Florida, you will meet the sales and use tax man sooner than anything else. Corporate income tax, communication services. Just a note, the audit clearing account, that's $100 million. That's how effective their audit process is. So Florida brings in a lot of money through their audit process. And refunds is about $500 million. When the economy's bad, the refunds go up. When the economy is good, the refunds go down. Juan, next slide, please. Okay, we're going to review sales and use tax. As you see, it's a significant part of living or doing business in Florida. Florida's sales and use tax taxes tangible personal property, as I said before. That's Home Depot, that's the furniture store, computers, that's meals prepared to eat, restaurants, desks, office machinery, equipment, business equipment, virtually anything you can touch, Florida taxes. We do not tax grocery items or medical supplies, but that's about it. Florida's commercial rental tax, we are the only state in America that imposes a tax on renting an office building, retail space, strip shopping center, or warehouse. Florida recently reduced its tax rate on commercial rentals to 3%, but it's something to know. Many counties will also have an add-on tax of 1%. Another thing subject to Florida sales and use tax is transient rentals. That's our bed tax, that's our rentals less than 6 months, that's Airbnb, that's VBRO, that's hotels and motels all throughout Florida. And the transient rental tax, again, is 6%. Admissions.
So Airbnb now is exchanging information with different states now. A lot of people are not realizing they're going to start getting, sort of like, hey, you've rented this thing, 50 times in 52 weeks, so it's
right.
Especially Miami Beach and Miami-Dade County.
Ray brings up a good point in the cat and mouse game. Airbnb has entered into what's called a voluntary collection agreement. And by voluntarily, I mean Airbnb is voluntarily giving the money to the state. Mandatory, if you enter the Airbnb rental program, mandatorily, they will collect Florida's transient rental tax from your guest and send it in directly to the state. So if you're using the Airbnb platform, it is no longer voluntary. They're going to take the money from your guest and they're going to send it in. And We have a lot of counties and a lot of cities that have a bed tax, Miami Beach, Coral Gables, all over. Many of these cities or counties will collect their share of it themselves, but just be assured, more and more national companies like Amazon, like Airbnb, Grubhub, the food delivery service, they are collecting the tax from your customer and sending it in whether you want them to or not. So admissions, that is Disney World, that is professional sports games, football, basketball, hockey, baseball, college and professional admissions, movie theaters and special events, musical concerts, all subject to an admissions tax. Amusement games, which we don't see much of, but if you put $1 in a machine and you want to play, Florida's sales and use tax applies, and Florida taxes certain services. They're small. We're not going to get into it, just to know that if you're intending to do business in Florida, let's get with the professional and know this in advance. I refer to this as Florida's sales tax, but Florida's sales tax has a close cousin known as a use tax. And I mentioned it earlier. The seller is obliged to collect the sales tax from you. If the seller didn't, and you are the user of the tangible personal property, the state will collect the use tax from you. So that's the who we catch first game. Did we catch the seller or did we catch the purchaser? And we're going to get our tax from either of you.
So for instance, if you buy North Carolina, a furniture piece and it's shipped here, and you think that you got away from the sales tax, you're going to get a little notice down the road that you owe the tax.
Yeah. Actually, I'll share a great story with you, and I'll also share an inside to it. North Carolina furniture manufacturers advertise, come to our state, buy furniture, get a U-Haul trailer or a truck. If you remove the furniture from our state, we won't collect the North Carolina sales tax. However, if you notice at the Florida-Georgia border and the Florida-Alabama border, there's a way station, and all trucks and commercial vehicles are required to stop. Well, if the way station sees your manifest or sees your furniture, they're going to email the Florida Department of Revenue, who will send you a bill. So there is one important thing to know. The way stations at the Florida, Alabama, Georgia border close at 4 o'clock. What is tangible personal property? This is the most misunderstood thing there is. Tangible personal property is not real property. Real property is a little easier to identify. It's anything that is real estate and anything you get a real estate tax bill for. It's a house, it is a boat dock, it's raw land, it's a shopping center. It's pretty much anything we know is real estate. Tangible personal property is just that. In our slide here, if you go into a home improvement store and you buy kitchen cabinets, put them in your truck and bring them home, you've purchased tangible personal property subject to our 6% sales tax. If you hire a kitchen cabinet contractor and tell him, I'd like to renovate my entire kitchen with all new cabinets, including your installation, he's performing an improvement to real property, and he should not charge you, the homeowner, any tax. So if you're purchasing electrical, plumbing, flooring, kitchen cabinets, air conditioning, roofing, landscaping, pretty much any kind of construction on real property, the contractor should not be charging you, the property owner, any tax. So good to know if any of you run a business in Florida, take out all the old invoices for real property construction, see if the contractor charged you tax. One. Okay. Construction, improvements, and repair of real property. Whether it's a lump sum contract, I'll do the whole kitchen for $100,000. Whether it is fixed price plus, which is I'll do all this construction for my cost plus a fixed price of profit, or whether this is time and materials. If your air conditioner breaks and the contractor shows up, he's going to say whatever the materials are and however long it takes, I charge $100 an hour plus the materials. Those are all still improvement to real property, and the contractor should not be charging the property owner a tax. So, Juan? Okay, Florida's incentives. Florida has tried its best. We don't need incentives in hospitality or in admissions. We have an awful lot of that, but we have an exemption for boiler fuels used in industrial manufacturing, whether it's natural gas or diesel fuel. They're exempt from Florida's sales tax. Electrical energy or steam used to run your manufacturing factory. If you're manufacturing a product here in Florida, electricity or steam that you use in the factory is exempt from Florida sales tax. Building materials used for residential affordable housing, there's a medium for you as you construct your building to gain an exemption from sales tax on all the building materials. Exemption for manufacturing machinery, repairs, and labor charges. You've got a forklift in the factory, or you've got a machine in the factory, whether it's a lathe, a drilling, a cutting machine. The repair, labor, and material charges are exempt if you're a manufacturing company. This is very important for foreign businesses wanting to do business in America. I said earlier, you must get with a tax professional before you start a business in Florida and register with the tax authorities. You register saying, I'd like to register for sales and use tax. I'm a manufacturing company. I'm located in Florida. Once you are registered, you are eligible to bring your machinery and equipment in from a foreign country, exempt from Florida's use tax. You're eligible to buy more machinery here in Florida, exempt from Florida's use tax. Many businesses wait till the state tax agency audits them and claims they did not pay the tax. So very important, Ray spoke about it earlier. You must get with the tax professional before you do business and start bringing inventory or machinery into the state. Juan? Okay, a few more exemptions. Pollution control machinery used in your business process. Machinery and equipment used for research and development. We have a lot of research facilities in the middle of Florida. Exemption for machinery and equipment used to produce electricity. This was put in place for our electric utility company, Florida Power and Light. All the machinery they purchase to produce clean energy, they purchase free from Florida sales tax. Two other incentives, which is very important if you're buying real estate. Florida has an incentive we referred to as Amendment 10, Save Our Homes, residential homesteads. And what it says is if you purchase real estate in Florida and it's your homestead and you declare it as your homestead, regardless of how much the market value of your home ever increases year to year, the taxed value of your home will never move more than 3% a year. So if you're buying a home here, very important to get with the tax professional. If it's your homestead, you must declare and make an application for homestead. But we've seen in the last 5 or 8 years in Florida, Ray, what are residential real estate values going up 5, 10, 15% a year?
At a minimum, 15 to 20%.
Yeah. So you want to be sure you apply for your homestead and you avail yourself of our Amendment 10, Save Our Homes. Amendment 1 is another amendment. If you happen to buy real estate that is non-homestead property, a factory building, a warehouse, a retail shopping center, an income property, whether it's rental property, pretty much anything that's not homestead. As Ray just said, we've seen real estate increase in value 15% a year. Some of the crazy ones, 20% a year. Florida limits the taxed or assessed value of real estate to no more than 10% a year if it's non-homestead property. So important to know that and get the tax professional before you buy. Juan?
And even if they raise it to 10%, you have the right to challenge it.
No, absolutely right. There is a process to challenge the value of real estate. It's a process, and you can go in and challenge whether it's your residential homestead or whether it's non-homestead property. Florida has 67 counties, and the real estate taxes or the property taxes are administered and imposed at the county level, and each county makes up its own tax rate. It's referred to as a millage rate. So this is not a statewide taxing scheme. This is a county. When I prepared this slide, I had all 67 counties sorted by the lowest tax rate, millage rate, to the highest millage tax rate. So if you're thinking of buying property, starting a business, and the real estate is a substantial investment, you may want to think about and consider where the real estate taxes, the millage rates, the tax rates are the lowest. Monroe County, 8.35 mills. Monroe County is the Florida Keys. Collier County is Naples on the Florida coast. Sarasota County is the west coast of Florida. Bay County is the northeastern portion of Florida, Jacksonville. Polk County, which is a very big industrial and farm town, is Lakeland in the middle of the state. Marion County is Ocala, 16.3 mills. Orange County, which is where Orlando, Disney World, all our theme parks is 17 mills. And then there's Jacksonville, Tampa, Miami-Dade, where Ray and I and our primary businesses are located. They made it to the top 5 at 18.6 mills. If you're thinking of running a business that's real estate intensive, you may wish to stay out of Broward County or Alachua County. Their millage rates or tax rates are the highest. And if your business is inside of a city that is inside of a county, the city can add their tax rate to millage also. So do your research, get with the tax professional before you buy a piece of real estate, just to know in advance what the millage rates are and what's applicable. And finally, if you're buying real estate and it's a $10 million warehouse building, and the seller says to you, gee, my taxes are $40,000 a year. And you say, gee, that's not too bad, $10 million. That's pretty reasonable. Only because of this 10% rule, his real estate was taxed at a base level of $6 million. The minute you purchase the property for $10 million, your tax base may move very close to $10 million. So again, if you get with a professional before you buy, you'll be informed as to what the potential taxes are.
That's a great point, Joe, because a lot of times we have people that come in that they're buying rental properties from overseas. They want to buy it here, and nothing against the realtors or anything like that, but they say we could rent it for this. We could basically get so much for this. This is what the sellers had in expenses. There's two components that you always have to adjust. One is not every seller is going to reflect all the repairs. So normally we do 6% of the sales. But insurance is a major component in the state of Florida. Most properties right now most banks are applying insurance, and they cannot get insurance for Florida. They will add it on to your mortgage if you don't get it. So it normally is skyrocketing. I mean, most people that are homeowners know. And the other point is it's easy to calculate what is going to be your new adjusted tax basis. So a lot of times people say, wow, they've told me you're going to make 8% rate of return on this duplex. No, after you run it, you're really losing or breaking even. So you have to run it. This is something that comes back to bite you, but only a year later. You only find out. A year later, you'll say, you sold your property, you owe us this. So that's a very crucial point, especially in real estate.
Okay. Ray, I want to add one final thing before we go to that. If taxes are important to you and you want to try to minimize your burden, the way Florida's real estate tax scheme works is they look at the taxed value on January 1st only, the first day of the year. And they determine what the value is. They mail a bill to the property owner in November, and it's generally paid in December, 12 months later. If you bought a property from someone that was taxed at $6 million, and you bought it on January 2nd, and you bought it for $12 million, your real estate taxes may very well double because the value of the property doubled. However, because the value for that year is fixed on January 1st, you, the owner of the property on January 2nd, will enjoy the lower tax burden for the rest of that year. So the short story is, if you're contemplating buying a piece of real estate in December of any year, get with the tax professional before you do. Delaying the purchase till the second day of the new year may produce a substantial savings. Thank you for your attendance, and Ray, thank you. We want to thank Spanish U.S. Chamber of Commerce. This was a great privilege to be able to present for you today, Juan Carlos.
Oh, thank you. Thank you. It's a great pleasure. And we are touching a lot of interesting points here. And now we're going to open the floor for Q&A. So all of you that are with us to now, if you would like to ask a question, and we have a few questions already, but you can send all our questions through the control panel that you can see on the screen. Just click on the tab that says questions and write your question, and we will address all the questions right away. So we have already a few questions that we're going to start sharing with everyone. So first question. Well, some people were asking about the presentation. We will share this presentation with all of you, with all the attendees. And also this session is being recorded, and we will also share the recording, and it will be uploaded to our YouTube channel as well. So don't worry. And of course, if you need more in-depth detail, you have right now in your screen the contact information from Abitos so that you can contact them directly. But going to the questions, first one we have, okay. Is there any tax exemption for Spain imports?
I'll answer that question. The U.S. classifies virtually every product on Earth, from food to machinery to furniture to jewelry to everything. They classify it by a commodity code. Certain items are entirely exempt from import duties, and certain ones aren't. I don't know specifically. There are just so many different commodities. if you follow the United States news, we tax heavily all commodities that come from China. Ray, I can't speak to any specific commodity from Spain.
No, every one of them is different. I mean, we normally look, once we look at the type of products and what's the components of that, then we see what is exempt and not exempt.
Okay, but to add to that, I said Florida's use tax. Florida does not exempt anything from wine to furniture to minerals to personal property from its use tax, which again is subject to 6%. So if it's a tangible good and it's coming to the U.S., it's subject to our use tax.
Okay, wonderful.
Juan Carlos?
Yes. Next question we have here. Regarding taxes, I know in Florida we could have or create a free zone, for example, for products that are not FDA approved. How those products are taxed? I mean, when are they taxed, when they are import or then exported?
No. Ray, may I take that question?
Sure.
Companies that want to bring into the U.S. their goods to later distribute inside the United States, or the United States is just a transitory warehouse. We have a lot of goods that come from Europe and Spain, and they're moved into a bonded customs warehouse, or known as a duty-free zone. And if the goods are unloaded and brought into that bonded warehouse or duty-free zone, there is no import duty and there is no customs tariffs on the goods. If the goods are turned right around and shipped outside the United States to the Bahamas, to, who knows, to Haiti, to Venezuela, to Canada, the US and Florida will never impose any duty or customs fees. So it's a holding area. If you take any of the goods out of that duty-free warehouse or bonded warehouse area and deliver it to anywhere in the United States, next to the front door at your bonded warehouse is the US Customs Service, and they will hand you a bill for the appropriate duty and customs service. You have to be a large business moving a lot of goods, but if you want to bring your goods into the US and some of it will leave, we can get you the assistance to establish what's known as a bonded warehouse or a duty-free warehouse, and you can avoid the customs duty or import tariffs on those goods.
Wonderful. Thank you so much. Next questions. Are tenants charged usage tax on rental properties?
Yes and no. If it is a commercial property, an office building, a shopping center, a retail strip center, a shopping mall, a warehouse, or a factory building, there is the commercial rental tax, presently 3%. If you are renting a dwelling unit, which is pretty much a house or an apartment, and the written lease is for more than 6 months, condominium, rental, home, apartment, townhome, anything whatsoever, you are exempt from Florida's tax. You're exempt from their transient rental tax. And since it's not commercial property, you're exempt from its commercial property tax. So if you're thinking of coming to America for the summer and you're only staying 4 months and you're renting a house and you're friendly with the landlord, enter into a lease for 6 months and 1 day, break the lease after 4 months, but because the lease contract is more than 6 months, there's no obligation to pay Florida's transient rental tax. So if I answered your question, we don't tax long-term residential rentals. We do tax everything else.
Perfect. Thank you so much. Next question, Jose asked two questions. First one is, what's the federal statute of limitations? And same for Florida. And the second question is, how can the losses carry forwards be utilized forward and backwards?
Ray, you take the first half of it.
I'll take the federal. You have 3 years civilly and 6 years criminally going back. That is the IRS. However, if you underreport your income greater than 25%, the IRS could go back to the day that they wish to. There is the highest area that the IRS is homing in on is criminal activity of tax evasion. What was the second? Because there was another component.
Carry forward losses or carry them back.
You could carry them for the 10 years and carry back. You can no longer do that. You can no longer carry back. It used to be you could carry back.
Okay. The statute of limitations on state tax matters, if you filed a sales tax, income tax, communication services tax return, the statute of limitations is 36 months from when you filed the tax return. So we file sales and use tax monthly. The statute is 36 months. If you've never filed a sales and use tax return because you did not get good sound tax advice when you first came to do business in Florida, call us, you have a problem.
Okay, thank you. So we have a question now that it's kind of.
Before I forget, because NOLs are different for individuals as corporations. So net operating losses, you have to determine whether it's a corporation or an individual. So I just wanted to, because there are additional limitations depending upon the type of NOLs of 80%. So I don't want to mislead. There are certain limitations and whether you could carry, how much can you carry forward?
Okay, wonderful. Thank you. So next question is from Niranjan. It's kind of a detailed question, so I'm gonna read it to you, but if you feel that it's too complex, we can maybe do that on the side directly with this person. But here's the question. There is a non-US person who has an LLC in Texas and owns a business bank account of Chase, I believe Chase the bank. He lives in the UK and receiving 7% payments in US bank account and the rest, the 30%, in a UK account. He's holding that LLC account, which only receives payments he don't use for the payouts. So how will he be taxed? Is all 70% payments would be taxed?
I'm going to implore you to speak directly with the tax professional. There are so many exceptions to that, to the right answer. We can get you the right answer, but it's
that individual may be thinking of just income taxes, but if that account is held in an LLC and he owns 100% of that LLC, depending upon the type of investment that LLC is doing, he could be subject to estate taxes.
Yes. So Juan Carlos, we can likely respond to that by email or phone.
Sure. So we'll send you the contact information, and Niranjan, if you have also the contact information from Raimundo, so send them an email directly to clarify this. Okay, so
I want to. You also have the U.S. tax treaty with the UK. I mean, there's just a lot. We're not trying to avoid it, but there's just a lot of moving parts there, and for us to give a definitive answer would be almost professional liability.
No, I agree. Completely understandable. Thank you. So next question is, How will the business handle cross-border transactions, including transfer pricing policies, intercompany agreements, and documentation to comply with US tax laws and regulations, such as those outlined by the IRS?
They've got to be documented in advance. I think that's your answer. There is no exception. There's no way to hide from transfer pricing.
Yeah, I think most people think that I'll just wait till I get selected for an audit and then I'll do the transfer pricing. That's not, you can't do that. You have to have a contemporaneous study already. They will give you basically 30 days, and that report needs to be dated. That report needs to be signed by a qualified person that does it, either an economist or that basically tells you what type of method are you applying, what type of industry, what are you sourcing, what are you bringing in? Is it a product? Is it a service? How is that product coming into the United States? What are you charging? And there's different methods that transfer pricing deploys to determine its reasonableness. Most countries throughout the world are part of the OECD. So there are market rules. So depending upon the product, for instance, I have people that say, well, I think 3% is okay. Well, how do you know 3% is okay? Is it benchmark? Is it comparatively? If we compare your business volume and what you're bringing in to other businesses throughout the entire country, is it reasonable? If a lot of people say, well, I provide all these services for the US. Well, the services that you provide over there should be factual, actual, and they will ask you for support in terms of general ledgers, in terms of even payroll to support that. So if you say, well, I'm doing cost plus, well, what's the cost? A lot of people we see inflating cost, then they're unable to support it. And what most people don't realize is a transfer pricing is an adjustment of sales. So if they say you underreported, we think it's this, they will do one adjustment. And if you don't have contemporaneously, it's extremely difficult to win the IRS because they're going to say you never had an intent to comply with transfer pricing. So transfer pricing is actually federal, and you can have transfer pricing for state. So transfer pricing would be border, inbound, or it can be outbound. Another country can look at transfer pricing and redirect the audit back to here. Typically Mexico, Canada, because of NAFTA, okay? Tax treaties, information. You have services. So those are two federal. Then you have state and local, where a lot of companies that do businesses throughout the entire states, they want to put a transfer pricing to reallocate cost to certain states so they could reduce the income tax at that state level. So you have, most people don't realize that, you have two components, state and local, that you're trying to reduce or normalize, or federal transfer pricing. But it's a penalty of 20%. So whatever the adjustment is, it's a penalty of 20%. So, and the report must be contemporaneously. If you get an IRS audit, the IRS auditor shows up, they may say, I'd like to see the report. And if you don't have it, that's like, first base, you're out, so they know you're now working backwards to try to get that.
Good point. All right.
Okay, thank you. One question. What are the minimum tax obligations for a foreign national that set up in the United States an LLC for, I believe that it's for consultancy services that will be done from time to time. So I believe the question is, many people think that might be useful for them to set an LLC in the United States for potential businesses. But if they don't have activities or they have a few activities, what would be the minimum tax requirements that they need to take into account for that LLC?
Well, if that's going back to what did you elect to treat that LLC as? Did you elect to treat it as a corporation, 21%? Did you elect to treat it as a disregarded entity if you're 100% owner? If you're a 100% owner, if the services are being rendered here, then the services are taxed where the services are taking place.
Yeah.
A lot of people play with jurisdictions. So they'll say to Spain, government, Hacienda, no, these services are in the US. And in the US, they'll say, no, these services are really rendered in Spain. So it's not taxed in Spain and it's not taxed here. The biggest area right now is Delaware LLCs, Nevada, Wyoming, where people set up to do exactly that, to basically evade both countries. And they're coming down on that. But assuming he's not doing that, if he performs services here and it's an individual, it goes from 10 to 37% plus Social Security taxes. If he's performing the services overseas, they're not sourced in the United States, they're still reportable and exempt, but you still have to report them.
Justin, you wanted to add anything?
No, Ray makes a point that I want to remind everyone is all of the advanced countries, certainly the EU and certainly the United States, they scan every passport of all of us moving into and moving out of the United States. And our tax agencies, the first thing they do when there's a question of, oh, did you perform this service in Spain? Did you perform this service sitting in the United States? They immediately pull out the travel log and tell you, you were here 40% of the time. We think you performed 40% of your worldwide services here. We want 40% of your money. So it's no longer a game of they won't catch me. I implore with everyone, don't play that game.
I had an executive for major credit card company that he basically is not a US person. He comes in for a board meeting. Sometimes he has board meetings in New York. Sometimes he has board meetings in California. Sometimes he has board meetings in Florida. What does federal and state do is, wait a second, you were 3 days in California. You're going to pay taxes in California for that services on top of the federal taxes. So the cuteness of, well, I have 3 passports. The IRS is going to say, okay, of the 3 passports, give me the one that you basically pay taxes in that country. And then they're going to add up and say, okay, you really are in that country, and they're going to see how much activity. So FATCA, exchange of information, I could go into Homeland Security, and based on your passport, I could pull out every single entry that you've done. At any point, whether it be California, New York, Florida, Texas, any point. And so they delineate whether it's transit, permanent, and it's very difficult to tell the IRS, I did all my services outside the United States, but you were here, 150 days. They're gonna prorate it by days and hit you with penalties. And we've had audits like that. Or you flew in your own plane and you don't think that in Opalaca, they're gonna make a note of it that you're in. There's a flight log, there's your passport. 2 things. If I don't catch you through a passport, I could catch you through a flight log that tells me what you came in and with whom you came in. So data is becoming very fluid when you're looking at these issues.
Okay, wonderful.
All
Thank
right.
you so much. And now the last question, because it's 25 past 12.
Okay.
It's how will the business manage its transfer pricing documentation requirements in the US, including preparing contemporaneous documentation to support its transfer price? So this is and another question about transfer pricing that you mentioned before. I don't know if you have something else to add or.
Well, I think the biggest errors that most people do is they get a transfer pricing, but they do not implement it into their accounting governance policies and procedures. So they have this piece of paper there, and they really don't invoice it. And then if they don't invoice it, they don't invoice it right. Why would I reflect a transfer pricing adjustment in an invoice? I should embed my transfer pricing into my pricing. So it's already in the system. So when I sell a product, the product already reflects the proper pricing. Or if I sell services, the product is, so the study has to be backed up by agreements. And that is what we call multilateral agreements between the companies. I may sell inventory, I may sell services, I may provide back end. So I may have people that sell in Spain for product that's here, that gets shipped to Latam. So I may have to pay Spain the sales commission that I'm paying that person. Well, you have to be able to understand how is this going to be weaved into your accounting, general ledger, your financial reporting between both countries. So that's really the biggest, I would say, the biggest errors that we see with people, because then they think that they've done it, but they didn't really do it.
Ray, if I can, I just want to add
Sure.
one last issue to that. You are best served if you're going to transfer goods and services into the United States, getting with an expert, developing your transfer pricing document. Even if it's written to favor you, it's documented in advance. Ignoring them until the man shows up will not accrue any benefit to you, okay? You can study this and develop a transfer pricing scheme that might benefit you a little bit in advance, but you're not going to do it within 30 days of the man arrived. So,
and by having a documentation that you've made an effort and implemented,
Right.
you will avoid the 20% penalty.
all right.
That's the biggest penalty you can't get away from. Because if I adjust your sales by $3 million because you posted sales in another country, it's not 3 million. It's 3 million plus 20%.
Yeah. All right,
True.
bravo.
So, and now, yes, this is going to be the last one because we got a new one. So considering the tax treaty between Spain and the United States, which would be the most tax efficient way to repatriate profits made in the US?
Well, the treaty between the United States and Spain, basically, there's two ways you could strip the US. Within reason would be a transfer pricing. But if you declare a dividend from an operational company here, it basically, it reduces it from 30% to 20%. So, and the credit will be taken in Spain. So most of all of our clients really, they don't really declare dividends. Most of the time, they're expanding. And since there is sort of like the parent company that has the subsidiary, there's always legitimate product or services that in essence can in fact legitimately reduce the impact. Now, keep in mind, in Spain is 25%, here's 21%. So why would I want to? So you gotta see what type of business, what's the horizon, how long what's your horizon? What do you want to do? Some businesses say, I want to have dollars versus euro. So they're globalizing their balance sheet. And some other business are just here for LATAM. So the activity in the United States is very little. They may have a representation office. Which may not even be taxable because they're just providing services for the parent. So you have to look at the whole process, but dividends between the United States and Spain is taxed at 20%. And that's treaty. That's basic. The treaty suppresses both codes.
All right.
Wonderful.
All right, good answer. Thank you again, Juan Carlos.
Yeah, thank you so much. It's been very productive. I know we touched a lot of interesting things. And as I said before, this webinar is going to be shared with all the attendees, and it will be uploaded to our YouTube channel, which I encourage you to visit. And we will also share the presentation, the link to the video, and the contact information from Raimundo and Joseph to your emails. So if you have any additional question that you would like to discuss with them, just send them directly an email and they will be glad and very happy to answer you. So thank you so much, Joseph. Thank you, Raimundo.
Thank you. It's always a pleasure to working with the chamber.
Thank you.
Wonderful. Everyone, have a great day.
Thank you all. Thank you. Bye-bye.